Join us right now for a closer look at the markets. Eric Freedman, U.S. Bank Management Asset Group Chief Investment Officer. Good morning to you. We could say it's the best day, but the context, of course, is in a bad week and a bad month. Where are we really, Eric?
Yeah, Andrew, I think that we're still in that price discovery phase. We have to keep in mind that the Japanese stock market lost 20% in 3 days, and that just ended on Tuesday. So that aftershock, if you will, is something that's obviously significant for markets to still digest. We still think this is a grinded out, improving landscape for investors. We still think that the bias is higher, not lower. To your and Melissa's comment earlier from this morning, look, we're only 0.5% away from being flat on the week. That's significant in terms of the work done across markets. So we obviously have a lot of sector stuff we can talk about, but we still think the bias is higher. But I don't want to think that this is a market that's done a good job of isolating the issues. The Japanese issue was a positioning issue. The fundamental bias we still think is a grinded out higher. So that's our working thesis for now.
How dependent is that on the Fed moving aggressively, and we can define aggressively, in September?
Yeah, I think two things have to happen. One is that you have to have some clearer messaging from the Fed, Andrew, with Jackson Hole. That's the next data point that we have to hear with a little more credibility. It can't be, hey, we're still waiting, watching. A signal has to be given about, hey, we get it that the economy is slowing and consumers are starting to feel the effects of a Fed funds that right now is still, Andrew, at 5.3%. It's been there for over a year. The second thing that I think we really need to see is a commitment about where rates will settle out. Of course, we and everybody else are very focused on when the Fed will start cutting interest rates. What's more important is where do they normalize? And again, before the dot-com crisis and what have you, Fed funds was at like 7% normally. Post the 08-09 crisis, Fed funds was at 1%. We think the answer is probably in that mid 3% level, but the Fed has to do a better job of signaling where they are. That's, we think, more important than when they may start cutting.
In terms of sectors, let's go sector specific. What would you touch and what would you run away from right now?
Yeah, for our clients that have more than a year time horizon, Andrew, we don't think the story has changed. We think the tech, the growthier parts of consumer discretionary, those are the spots that we still want to invest in. That's where, and again, you're going to hit earnings later today. The cyber trade is one that we still think is worth revisiting. We also think the AI trade will start to broaden out. So that's where corporate CapEx will be concentrated. Companies are really focused on becoming bigger, stronger, faster through tech spend, so that doesn't go away. The thing that is actually pretty interesting to us is the strength in the real estate space. That's not really been an area, of course, everybody knows about San Francisco office and some of the challenges within the broader multifamily landscape. But if this were really a big growth scare, Andrew, we'd expect to see a significantly more negative reaction in REITs in particular. So the fact that credit's hanging in there, the fact that real estate's still doing well, we also think that that's a spot that investors should have on their ledger.
I understand, Eric, that you're bullish longer term on AI, but how do you think of the space in terms of its valuation? You had mentioned going to sort of the broadening out the AI trade, which imply not the epicenter trades like an NVIDIA, which has been underperforming the market for some time now, for a month plus now, but going to some others which have not been performing. And I wonder how you think about that in terms of valuations.
Yeah, I was fortunate, Melissa, to be on the board of an AI firm. And so seeing the evolution of the space has been really fascinating. I think that right now, and your team has done a great job of covering this, there is more of a concentration in the suppliers and the hyperscalers, et cetera. That's the first part of what markets are still trying to figure out. The second leg that we think is really interesting is what companies start adopting the technology and using it at a broader scale and actually win customers because they're using it. That, we think, is broadening out within some of the stronger consumer discretionary companies, some of the larger big box retailers. Those are places where we think there will be more concentration, winners versus losers. That's where we think the next part of the trade is. And
you're investing that way right now?
We are. We think that still, again, back to the notion of the growthier part of consumer discretionary, that's where the adoption is actually occurring. So that is a space that we still think, again, on weakness, you can accumulate. Again, if our marker, if you will, is NDX above 17,500, Melissa. That is key for us to stay involved on a still bias towards technology. That's the way that we're thinking about the setup right now.